Here with more on Apple and a few other companies in tough life stages is Aswath Damodaran, professor of finance at NYU Stern. I'm sorry if we had to get you out of class a little early, Professor. Welcome.
Oh, thank you, Kelly.
Let's start with Apple. The obvious, many people said, okay, once they went through this rebirth, once you get iPhones in everyone's hand, what's the metric goes here? 1 billion install base. The stock is a buy, massive buybacks. What can go wrong? Talk a little bit about what you think is going on here.
Apple's been a middle-aged company now for a decade. I mean, this isn't new. It's, I think once we got people out of flip phones into smartphones, it became a question of, really hitting, middle single-digit growth. I mean, you get these spurts around new updates, but it's been a middle-aged company. I think the problem, though, is the smartphone business seems to be running out of juice. I'm stuck on the iPhone 12. I don't even have the slightest desire to even look at the iPhone 16 because not enough is different about each version of this. And Apple gets about 75% of its value from the iPhone now. It's become heavily invested in the iPhone and the subsequent updates, which means you're going to live through these update to update, corrections around the price. So it doesn't surprise me that people are a little disappointed, but looking long term, my bigger concern is what if the smartphone business itself starts to go into decline?
I mean, we can argue that it already has. The bulls would say it's all about services, it's all about subscriptions, and it's all about stock buybacks. But not to put too fine a point on it, what do you think the stock is worth here?
No, I don't think the stock is massively overvalued in any way, but I do think that all of those things are good, but you're trying to fill in a really big space. I mean, you can add the services business, but the amount of money that Apple makes on its iPhones is so immense that making up for it is not going to be easy, even with 3 new businesses. So the services business and the ecosystem that they have has to be dramatically large for it to make up for the iPhone. And that's always going to be a concern when you invest in Apple. As for the buybacks, that's really not an alternative. It just is a return of cash. And Apple has been very good about returning cash for much of the last decade. I think collectively, Apple has returned more than $600 billion in cash over the last decade, which makes it the greatest cash machine in history. So I like the company as a cash machine, but not as a growth engine.
Yeah, and I think even at 188, you were saying, look, it's at 215 now. We're in the neighborhood of fairly valued, not dramatically over, but also not dramatically under. And a lot of people are probably just going to. I thought it was interesting that Berkshire sold half of their position. You'd think this is the kind of just sit on it forever. I think that was their intention. Does that sale tell you there's anything else at the margin that could really go wrong?
I wish I would read a signal about Berkshire Hathaway thinking Apple was overvalued. I think the reality was Berkshire was about 30% of its portfolio was Apple.
Wow.
I think it was just a concentration issue, which is when you have a third of your portfolio trapped in one company, it's a very dangerous place for anybody to be. So I think the pruning really reflected that overconcentration.
I hear you, but I hear Munger's words echoing in my ears when he says, you don't want to, spread. What was the phrase? You don't want to spread your eggs in different baskets. You want to put them all in one basket and then watch it very carefully. So I would view that concentration as a benefit almost.
And the counter I would have to Charlie is, I remember when he said that at his meeting would have been, would you take 30% of your money now and buy any one stock, no matter how great it is? And I'd wager he'd say no. So It almost seems like we have 2 sets of rules, one for investments we're going to make and one for investments we've already made. I think we need to be consistent.
No, that's very interesting. By the way, he's hardly alone, or they are, in facing that kind of dilemma, which a lot of investors run into. That's interesting you bring that up. So many other names, honestly, I wish I could run through. Intel, Walgreens, Starbucks. Let's just talk Intel because there's more news about more funds they're receiving from the government today. And of course, it's an important issue that we replace, Chinese chips and Navy ships, and maybe Intel can do that. Sorry for the rhyme. But what would you say about this company's valuation and prospects here?
I think Intel is all 3 companies are aging companies, but what makes Intel different is the business it's in is growing. I mean, look at NVIDIA, same business, look at the growth you're seeing. Intel's problem was too much Me Tooism and too big a bet. So both the Foundry, Intel Foundry, which was their attempt to be the next TSMC, and the AI chips, they've spent immense amounts trying to be the next NVIDIA. I think they've lost on both counts because TSMC and NVIDIA are way ahead of them in each of those markets.